Joining me here in studio, I got Cem Karsan, Senior Managing Partner at Kai Volatility Advisors, who told us last time the season of flows was not to be ignored, right? Heavy flows to the end of the year, and that the window of weakness wouldn't be showing up till like mid-January. Is that right, Jim? Welcome back.
Thank you. Yep, good to be back. I was thinking about wearing my leather bomber jacket and aviators and putting mission accomplished on the back here.
Does it kind of feel like that's what Powell did yesterday?
It kind of feels like what Powell did, right? I think we accomplished our mission. I don't think that Powell did. So I think we'll talk about that a little bit. But first, let's review why are we up? Why are we up 15% off the bottom? We kind of called that bottom October 31st, November 1st.
Yeah, you hit that bottom real nice. That turnaround that right was before the highly speculative part of the rally.
And 15% in a month and a half. 15% in the S&P.
Yeah.
It's pretty crazy. Why is that? Let's review. One, vol is very well supplied, so we couldn't get that breakdown that we needed, and the window was closing, right? Biggest expirations on the calendar are December, which is coming here on Friday, end of quarter, and January. All of these have massive open interest, and if that vol is well enough supplied where it doesn't break, all that leads to Vana and charm flows coming back. All the holidays, very small volume weighted time, 30% less than the rest of the year, right? So real acceleration through that Vana and charm buyback. And then on top of that, the biggest one of all, the end of the year collateral reinvestment that's coming. Now we're up 24%. 24% for the year. 24% of a $100 trillion market. That's $24 trillion of new collateral. $24 trillion. We can talk about how much gets reinvested Jan 1, but about 20% of it just came in the last month and a half.
You view that as now like capital being put to use, but that would require people selling their positions, right? Is that, or
No,
you're saying just
to,
on the margin they can now just pile on?
People, not everybody, but for the most part, people try and keep risk when their investment risk constant.
Okay.
And there's a ton of leverage in the system. Everything's built on leverage.
Sure.
But that leverage, once you go up, needs to be re-leveraged at the new levels.
Okay.
Because there's leverage in this system, that amount of money now has to go back to work.
Right.
So we can argue how much of it goes back to work when, but that's new money.
It's sort of like a second derivative type of thing where the speed of the ascent moves up because you're able to put on more margin and leverage.
Think of it as a real estate investment. If you have 25% down, right? 75% up, all of a sudden the value goes up. You need to take that money out and reinvest if you're going to get the same returns with the same appreciation. And that's how it works in the system. So that's a critical part of the system. It's a momentum driver, and it comes, and there are windows where that gets reinvested. First of the year is by far the biggest. That's the biggest driver of the Santa Claus rally and January effect historically.
You strike me as a man who believes in the wealth effect of financial markets, I would argue then.
Isn't it ironic? now that we can pivot over to talking about mission accomplished for
now
Powell,
you know where
right?
I'm going with that.
Right, absolutely, right? I mean, if the market continues to rally here, and guess what? Interest rates come down, so now investment in real estate goes back up. A lot of other areas, it stimulates the economy. Is it going to be mission accomplished? You tell me. Especially in the face of what we're still seeing very secular effects on services, on labor, right, that are very, very strong and still very, very hot. We're at 3.7% unemployment.
Yeah, financial conditions
Is it time to pivot?
a year.
Is it time to pivot? Why would this be happening so quickly after all the Arthur Burns talk, after everything else? Why would this be happening? Is it a coincidence that next year is a election year? I'm not a conspiracy theorist. We look through history. The chairman's bow to politics. It happens again and again and again.
You think there's pressure?
100% there's pressure out there, and there's an excuse to do it, right? Inflation is down enough. They can make the argument that mission is accomplished, but it is rhetoric, and don't forget about that. It is rhetoric alone. This will be another transitory moment.
I'm not a conspiracy theorist either. I try not to stretch into that realm. However, I would say that there is some evidence because when inflation was really, really high and it was at the starting line of every speech the president was giving, Jerome Powell sure was a heck of a lot hawkish more then.
100%.
So that is not unreasonable, I don't think.
No, and at the end of the day, we can try and talk about independence, but the Federal Reserve is there to do the bidding of the U.S., the United States. It is here to do whatever we think needs to be done at a given moment.
How come we're getting such a massive bond rally then? And I know you mostly think stocks, but you're in the macro too, because that's the part to me where like stocks melt up, fine, dollar down. If we're going to move faster than the ECB, fine. But wouldn't this be a pro-cyclical event like you're describing that would be good for growth and good for long rates? Not the short rates, but the long rates.
I think you're trying to subscribe some rationality to trading. It's a supply and demand market. Don't forget, during the Silicon Valley bust, we saw things go from rates 10-year go from 4 all the way down to 2.5.
Yeah.
And then where did it end up? At 5.
Yeah.
We had a pretty big round trip pretty quickly.
You think we could be in the store for another big round trip for yields?
Not only will we see a round trip, it's not going to happen as quickly this time around, to be clear.
Okay.
But I definitely think that we'll be higher than 5% by the end of next year.
Oh, I was just about to ask you to give me a next year 10-year call, and you got ahead of me. I love
this
it.
one will be more interesting because it'll be steepening. I think the cyclical reinvestment here will really stimulate going forward. People will start picking up on that on the longer end of the curve, whereas the pivot itself will bring down the front of the curve a little bit.
You're making me feel good because yesterday our social media guy literally tagged my closing segment with, "Is this guy lost his mind?" because I took the green light off my bond risk radar because it seems like a moment where the curve should re-steepen.
Secular inflation is embedded. It's a function of deglobalization, populism, competition globally. These are things that are not going away. This is not the last 40 years economy, right? This is a demand side economic model. You better believe fiscal policy is on the way next year. And that's all. And by the way, there's already a lot in the tank. You don't need much more. If we're now monetary policy pivoting, guess where things are going, right? You're seeing it today. You saw it yesterday. That's where things are going. And that is not deflationary.
All right, the crumbs that your fans are wanting. So let's come back into the nitty-gritty details here of the timeline. The window of weakness that you told me you saw when we last spoke was Jan 16th or 17th, you said?
January 17th is VIX expiration.
Okay.
That 17th into the 20th, the end of that January expiration would be the time where you should really be, if all the signs are there, which they continue to be, where you should be looking to kind of exit longs and get short.
Okay, so we can ride it a little bit here, you think?
Yeah, just like we've been riding it, I think you've got to be constructive for now. That doesn't mean you're not going to get pullbacks along the way. In particular, right now, I would expect post-expiration, and I think this is an important thing, everybody is getting a bunch of implied volatility as December expiration expires tomorrow morning.
Okay.
Why is that? December expiration is higher. There's been a lot of demand, a lot of open interest. It's easy to sell that what's high and buy a week or 2 weeks behind it, right? So as that decays away, as we're seeing today, then everybody decays into very cheap implied volatility. If you can own a 8.5%, 9% implied volatility in January 3rd, January 5th, very low implied volatility, and then fund it with selling a 12, a 14, right? Guess what? The one you decay into is even cheaper. So people are getting very, very long implied volatility after today. There's been a bit of short vol, right, in gamma, in that now what's a 0 DTE, right? But as that expires tomorrow, vol will be lower. Everybody will be decaying long, and guess what? Here come the holidays. So expect the next week or so to be very low vol, not what we've seen the last couple of days in terms of realized vol. Some digestion again, a little pullback would make a lot of sense here. But if it just kind of digests like it has every other time, expect another run before the end of the year, and then again into January 17th. If we get up near those highs, which we're starting to tease it, I think it'll be a little bit slower from here on out. But if you start to see that again in another push into January 17th, that would be the sign. We're already starting to see what I talked about for the blow off top, which is market up, vol up broadly. That should continue broadly. The long end of the curve is a buy at this point, meaning 2-3 months out. Short could be a sale just to collect decay against it in the meantime. But market up, vol up is likely to be the next move, and calls are too cheap in the back end of the curve right now.
I got a little something for you too. I'll sprinkle in a Renick crumb. We've got a chart that I was going to show later in the show, but it works for what you just mentioned about the blow off top. The combined RSI right now, and TLT and Qs is 145. It's the fifth highest reading ever in those two combined. So things are very hot right now.
I mean, we are at the 3 standard deviation of the 20-day. That doesn't happen too often, and go look at the history of that. That doesn't bode well broadly. That said, usually it rotates not right away off that. It takes a little bit of time and digestion through that. But as the short squeeze subsides here, right, which it is in the process of doing now, eventually it decays away and it leads to digestion. The question is, do we get a turn now or later? And given the flows into January 17th, I would say it's a bit of digestion before that's coming. So you do want to get prepared for what's coming past Jan 17th. You do want to get long vol. This will be a bottom in vol, in my opinion, in the next week or two. But again, long dated, because there will be some decay, especially don't forget at the end of the year, we have that JP Morgan trade and several other things that will be helping to provide a little bit more supply of vol in the short term.
All right. Careful, Jim. The once mystery man. You're laying it out pretty clear for us here at this point.
Hey, we laid it out clearly the last couple months.
That's
and,
true. It didn't affect
the
quality of the call. All right. Not only do we get the timing for the equity traders, but like the bond call for next year as well, because a lot of folks are going to be too scared to make that one at this point. All right. Thanks, Jim. Great convo.
Always great being here.
Cem Karsan, Kai Volatility Advisors.